And finally, inside of this chapter, chapter 7, we get to what my favorite topic is in all of finance, the efficient market hypothesis. What is the efficient market hypothesis? The efficient market hypothesis is the idea that prices, particularly stock prices, reflect all available information. What does that mean? Isn't that kind of weird? What does that really mean? It means that if you have a stock that's going up and down, stock goes up, stock goes down, stock goes way up, stock goes whatever it is that stocks do, however random they are, that they reflect information as we appreciate it in the market. Okay? And this could be a series of things. And so we could say something like, here, this company gets a new CEO. Right? A new CEO comes in and the market says, hey, look, this guy has a new CEO. The price of he's going to make us a lot of money. The price of the CEO, or the price of the stock for this particular CEO goes up. And that's fantastic. Everybody's happy. And then in here, like on this day in here, we find out that the CEO is stealing. Okay, we find out that the CEO is stealing and the board of directors has to come in. So on this day, everybody says, oh man, we just realized that the guy we used to love is really a jerk and he's stealing money and he's going to lose us a lot of money if he stays in place. He has an integrity issue. That's not good. And then down here, we find out that the board hires a new CEO. These three data points are data points of information. They bring to us the idea that something is going to happen in the future. Something is going to change. And so here, when we first have a new CEO, we have an up cycle in the price. We find out that the CEO is stealing. We have a down cycle in the price. We finally hire a new CEO. We have an up cycle in the price. And the entire time, we have this average kind of curve that moves in the overall prices. In the meantime, however, the prices reflect all the available information. And so you'll note that the prices here at this point don't reflect here all of these prices between this time period and this time period do not reflect the fact that the CEO is stealing. How come? The CEO is stealing the entire time of his tenure. Why don't prices reflect that reality? What these shifts in prices reflect are the information that are available to all investors. Okay? Even though in this time period the CEO is actually stealing, we don't know that. Once the announcement comes out that the CEO is stealing, then we can make a reflection of our perception. And everybody sells. Right here, everybody sells. And so that's what's happening here. We are reflecting based on that information. And so we have three different types of the EMH. They include type number one, the weak form. I don't know why I blanked out there. The weak form means that current prices reflect. I'm just going to write the whole thing out. Reflect historical information. Historical information. And what does this mean? What this means is that the prices, that we look at prices from a historical view. So let me just scroll out of the way here. Remember how we talked about, just do it right here. We talked about how we looked at prices and the returns for those prices, and we'd get 1 or 2 or 3 or 4 or 1 or 2, and we'd build this expected return based off historical prices and some level of risk. Well, everybody has access to this same data. Everybody uses historical prices to look at and calculate expected returns, and we can calculate risk based off of those expected returns, but everybody has those prices. As such, we're able to say that the current price of the stock, scrolling back up here, these prices of the stocks are what the prices of the stock are, not because the CEO is stealing or because we get an announcement the CEO is stealing, but because we can see what the historical values of the stock look like the past 30 years, and we make a decision on our willingness to hold that stock therefore the price reflects all of the historical values. Okay, that's basically an argument in favor or against the expected return and standard deviation. Next, we have what we call the semi-strong form. The semi-strong form says current prices reflect historical information and current information. What is current information? This is stuff like news. Okay, so in the example above, this is an example of the semi-strong form. The CEO gets hired, prices go up. The CEO is caught for stealing, prices go down. New CEO gets hired, prices go up. As the announcement points come out of each activity, then we can see that the prices then change. The strong form is the hardest to work with, and we won't get into detail, but this is basically insider trading. It says that the current price reflects historical information and current information and non-public information, meaning that prices also include information that we don't know in the market. In our example above, between here and here, there exists non-public information. All of this is the timeline when the CEO was stealing. And the price of the stock doesn't go down. The price of the stock, if you believe that the strong form says the prices reflect this, and non-public information, then this time should go down because the non-public information that the CEO is stealing would then be reflected in the price. Clearly, that was not the case in this scenario. Here, we have a semi-strong form waiting for the CEO to steal, and then the price goes down. Okay? Now, the efficient market hypothesis is very, very important because, not because of the three forms, which are very interesting, but because of the idea of active versus passive investing. Active versus passive investing. What does that mean? It means that when we look at, let me see if I have an extra space down here at the bottom. If I were to look at the S&P 500, I'll just bring up the S&P 500. Oh, excellent. Okay. So here's the S&P 500 for the previous however many years, from 19, and we're going to take a look at the 1980 to 2016. The efficient market hypothesis basically is going to turn to us and say, hey, look, if you start investing in 1988 and you just leave it in, your market portfolio is going to go up, and the market portfolio is going to go down, and the market portfolio is going to go up, and then it's going to go down, and it's going to be up here sometime. And that's not bad, right? Over time, your overall portfolio is going to look something like that. But active investors believe that they know when this is going to happen and when this is going to happen. So they would sell their portfolios up here and they would buy their portfolios down here. Now, here's the rub. If the efficient market hypothesis says that current prices reflect all the information that's available, historical information and current information particularly, then we all know what's going on here. We all know here, we all have access to the same information. So the big question is, what is it that you would know that I don't know that would tell you to sell? And the answer for many people, for many, at least academics, is that you don't. So you don't know that you're supposed to sell here, and you don't know that you're supposed to buy here. As such, your best strategy is to buy and hold. Buy until you get to the very end. This is known as the passive strategy. If you believe that all prices reflect all available information, then you believe in a passive strategy. It basically says you can't tell what the stock market's going to do. As such, you follow a random walk, or the market follows a random walk. If you have an active strategy, you say, yes, I can sell. I can sell here because I know the market's going to go down, and I can buy down here because I know the market's going to go up. But there are very few people in 2000. This is 2008, in the middle of the financial crisis. There are very few people at the middle of the financial crisis that were screaming buy, 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 buy. Nobody was really saying anything like that. And so here we are, and we're nice up above and fat, and it looks like, if we were to zoom in here, just look at this guy. It kind of looks like a little hilltop, right? It looks like it's going to go down. So you might be thinking to yourself, I should sell. Now's the time, right? But here's a little hilltop. Here's a little hilltop. Here's a little hilltop. Here's another little hilltop. Hilltops are everywhere, depending on how far you look. You really don't know, and if you do, please come and tell me. You don't know if this is going to continue to go up and do whatever craziness it's going to go up, or I'm going to use red for dramatic effect, or if we really are starting one of these other cycles and the stock market's going to go down. And there are computers running these kinds of data, the data to try to calculate historical returns for this, historical returns and all of this, and trying to figure out what we know and what we don't know, trying to pick between active and passive. Because if you can beat passive, if you can beat a passive investment plan, if you can beat this, if you can beat the buy and hold, then you have an advantage over every other investor in the world. You know that the stock market's going to go down. And people spend a lot of money trying to figure this out. And the reality, as far as we can tell, is that nobody really knows. And you just have to make the best guesses you can if you go active. However, if you go passive, you may not get a full and completed you may not take advantage of every single upswing all the way, but you're also not necessarily taking being disadvantaged by every downswing. What we do know about the market overall is that it grows. It grows in an upwardly sloping exponential curve, and probably will continue to do so for some time. It's up to you to decide whether you believe you should be in a passive or an active plan. And to accomplish that, most people go back to the CAPM equation. The CAPM equation, to remind you, is beta, expected return of the market, minus the risk-free rate. That's always a bracket. I always do that wrong. Plus the risk-free rate. Because this guy, the beta, and the expected return of the stock, that you're measuring, will give you an appreciation of what it should be instead of what it actually might turn into. And that's a little confusing, but let me put it this way. If you have all of this historic information and you plug it into the CAPM and your expected return is 8%, but you figure out that for this particular stock, the expected return is supposed to be 9%, then you know something that we don't know. And you make an investment into this and take the 9% instead of what everybody expects to be the 8%. The question then is, do you have the guts, the courage to actually make the purchase based of your investment? And if it comes back and gives you that higher return than the expectation, then maybe you do know. And if you can figure that out mathematically, then you should be actively investing because you have figured out the secret sauce. And if you figure out the secret sauce, please come and see me because I have no idea what it is, and neither does any other financial PhD in the country, no other investment professional in the country has it, and nobody knows what that is. And if you have it, you don't know that you can hold on to it. And let's think about that for a second. Let's think about what would happen if you did have it. If you had the secret sauce and you began to buy and sell with the secret sauce, what would everybody around you do? If you had the secret sauce and you were making lots and lots of money and you were never wrong, I would start doing whatever it is that you are doing because it's going to make me money. And if I do whatever you're doing, it's basically, and everybody else starts to follow along, you basically eliminate the advantage. It's one of those deals where if you use it, you lose it. So you may have figured it out, but you can't use it because as soon as you start making money off of it, everybody else jumps on board and you eliminate your advantage. As such, many investment professionals will encourage you to do the buy and hold or the passive strategy. And all of that is based off of the efficient market hypothesis.